Hello and welcome to this live episode of GoldCore TV. I'm with CEO of GoldCore, Stephen Flood, and I'm Marco Byrne with us as well. And we are going to be talking about the one and only thing in the precious metals market that people are talking about at the moment. And this is the short squeeze in silver. We've seen a significant rally in the silver price over the last 24 hours or so. And bear me one second, I turn on mute myself. I'm getting a bit of feedback there. But we've seen a massive rally in the silver market since last week, started last week and has continued now since the opening of Asian trading last night. This comes on the back of a Reddit article. We all know at this stage probably about WallStreetBets, the subreddit on Reddit, and they're looking for silver to go to $1,000 an ounce. I can discuss with the boys now whether that is actually on the cards, whether it's possible, what the likely reality is, or what the potential is for pushback on that. But I suppose this all came out of over the last couple of weeks. We've probably also been hearing about GameStop as well. So we've seen massive run up in shares of GameStop, got up to $500 and more, on the back of WallStreetBets, the subreddit, buying up these stocks. Retail investors, loads and loads of retail investors buying up the stock, and they're trying to put it to the hedge funds that have been shorting this. So we've seen massive volatility. We've seen large losses in hedge funds, opportunities for others, but massive volatility. And now they've turned their eyes to silver. And that's what we're here to talk about today. Steve, what have we seen now in the silver price?
Yeah, I mean, it's up strongly today. It's above 8%. It's moving. It's not a blowout. I mean, like, it did start up. It opened up around 5.5%, 6% last night when it opened in Sunday trading hours, the futures market, that is. And it's meandered a little bit since then, pulled back a little bit. It's still strong, a huge amount of flow into it. I think what we have is a situation where the market is being caught off guard, the physical market, that is. A lot of the standard stocks or the buffer that you'd expect to see with dealers has been just gobbled up immediately. There's huge demand for it. What I'm looking to see now is what happens when the ETFs open up in New York. What happens there? And I think we could see a major leg up at that point. But yeah, the supply of small coins that you'd expect to see in every day of the week has been gobbled up, and the premiums are beginning to blow out as a result. So premiums have, if you can get silver, you're going to pay a pretty price for it, far in excess of the spot price. And I think what happens now is that the machines behind the cogs and everything behind in the industry will start to gear up. Metals start to mobilize. Stocks will start to free up a little bit more. But it depends really on the demand side. And I think we'll talk about a little bit more about in terms of the investor psychology in here, and people running towards something that's become in vogue very quickly, and how careful they need to be.
Mark, now one of the claims here by WallStreetBets is that the silver market is A, the most manipulated, and B, the most undervalued asset that there is in the world. Is that something that you agree with?
Yes, yeah, it's something we've been saying for many years. You can't definitively say it's the most undervalued asset in the world, but it is definitely one of the most undervalued assets, if not the most undervalued asset, because silver, even at today's price, I think we got up as high as 11% at one stage. In the last little while, we went over $30 per ounce this morning, and that was the biggest one-day move, I think, in something like 11 years. So, but that's come on the back of, if you look at the silver price historically, why it is undervalued is that silver was at nearly $50 per ounce in 1980. So 40 years ago, it was at $50 per ounce. And then nearly 10 years ago, it was again at nearly $50 per ounce. So if you go back to 1980, if you adjust for inflation the last 40 years, there's been quite significant inflation over the last 40 years, particularly in asset markets, as we know, because a lot of this QE is going into, and the printing, our electronic creation of trillions and trillions and trillions of dollars, euros and pounds, and every other fiat currency is going into the asset markets. It's gone into the stock market, the bond market, property market. And the Dow Jones, as we know, is at 30,000. So the Dow Jones in 1980 was actually at 1,000. So the Dow Jones is up 30 times, whereas silver is actually half the price it was in 1980. I don't believe there's any asset in the world, whether it be a stock market indices or a commodity, is half the price it was in 1980. 180. So these guys have realized that the GameStop, the games they were playing with GameStop, shall we say, and the speculation that was there, they realized that that can actually be used against them. Hedge funds and big banks can go in there and they can push the GameStop stock anywhere they want, you know. So whereas an asset like silver, which has been manipulated for years and is undervalued because of that manipulation, and the banks have actually been prosecuted, been found guilty, they've been fined, you know, billions of dollars of fines, but you know, these fines are mere slaps on the wrist because the profits they make on their trading desk vastly dwarf the fines they've had. So these guys have sort of realized that the Achilles heel, I suppose, you could say, of whether it be Wall Street or more particularly, you know, the Bitcoin and the crypto evangelists are very much focused on the fiat, and as we have been for years, on the fiat monetary system. And the Achilles heel of the fiat monetary system is the dollar and the infinite creation of dollars that's been going on now, or near infinite creation, I should say, that's been going on now for in recent years. So I think they're wise actually, because you know the stock thing is just a short-term thing that they could make money on, but it's not actually going to hurt anybody on Wall Street or any of the big Wall Street banks that they and indeed officialdom, whether it be the U.S. Fed or the Treasury or the central banks who are perpetuating the Ponzi scheme that we see in markets today.
Fundamentally, though, the silver market, the precious metals market, they're a different animal. So we've got the spot price of silver. We've got physical silver, so the coins and the bars that people actually buy, and the other silver products that people actually buy. But then we've got a huge market in derivatives and derivative products, which are not physically delivered as such. What's the size of the derivative or paper market in silver in comparison to the physical market?
I don't know the numbers off the top of my head. I haven't looked at it in a while. I've been trying to take a little break sabbatical, but it's dwarfs it basically, you know, because obviously with all these markets, but particularly with silver, of all of them, silver, both the overall derivatives, the overall futures market vastly dwarfs the underlying physical asset. And I just have I'll drill down into that in the coming days and get up to speed again. But I'll just give you one fact on it. So to give you a sense of the scale of it, so I have it here. Yeah, so there's according to the COT data, the biggest four entities on the COMEX are short 60,000 contracts, and the next four are short nearly 20,000 contracts. So that's worth a total of 400 million ounces of notional silver, ounces of silver.
That's 60,000 contracts, and each one of those contracts is 5,000 ounces of silver. Isn't that correct?
Exactly, yeah. And then annual mining silver production is only 800 million ounces. And there's actually been a supply-demand imbalance there for a few years now, whereby there's been more demand for silver than there has actually been supply coming out of the ground. So that there gives you the scale of it in terms of the short position. And that short position, as I said, it dwarfs the short position vis-a-vis the annual production and the more importantly, the above ground stocks of silver that are there. It vastly dwarfs it compared to gold, compared to any other commodity in the world, you know. And that's what some of these guys don't know any of this, because you know we've been looking at it for years, obviously, but they are hearing and they're beginning to educate themselves. I think they've moved away from this sort of speculating on stocks to saying, well, hang on, where is their fundamental value here, and where can we make money in a safer way and hurt the man, you know, hurt officialdom, because they're angry about what's happening in the world, you know.
So the silver market, as we know, is primarily driven by the futures price. It's primarily driven by the paper price. Now, what's happening a lot then is in terms of the WallStreetBets crowd, what they're doing now is trying to buy up the physical. But again, that's coins, that's small denomination coins and bars that they're buying up. Whereas we've got a market that is primarily controlled by very large players. The large bullion banks that are dealing in minimum size contracts of 5,000 ounces a contract. So is this a fundamental, obviously this is a David versus Goliath situation, Steve, but is it possible for them to actually affect the market?
Oh yeah, massively. I mean, you buy a futures contract, you've got your 10-to-1 leverage. So like with very little capital, you can have a very large impact on the price of something. Futures are by design, designed to give leverage exposure. Now it's possible on the other side of those trades, you won't find much of a market and the price could move around a lot more. But physical market's important, but the physical market can be found, wanting or empty or finished or nothing available, and the futures market will trade away until you get to expiration and they have to make delivery, and then the futures market will trade into that possibility. But a lot of brokers will settle for cash anyway, and the people on those platforms don't get the actual ability to settle for physical. So it's so only those brokers that actually allow that. I'd expect maybe if that was going to happen, you're going to find those brokers are going to just rewrite the rules and say, right, you know what, guys, you can have your futures contract. You're just not going to take physical delivery. It becomes a pure paper-based
cash settlement.
Cash settlement only.
You buy your contract. Your contract goes up. You stand for delivery and say, I want my bars, and they say, well, actually, no, we haven't got the bars. Here's cash settlement. I'll settle the difference. Here you go.
So there you go. Exactly. Yeah.
There isn't a requirement for the physical bars behind that to actually either A, exist or B, be available.
Yeah, and you might be sitting on that golden Willy Wonka ticket that allows you to get a physical bar. Those ones up to now in the ordinary course of business, there are people who need to get those physical bars. They use this as a way of actually, bringing in physical stock using the futures markets. Most people in the market only settle for cash, are quite happy to do so. If you have a new group of people coming in and they're trying to change the market by taking advantage of that physical delivery option, arguably you're going to see that the powers that be will intervene like they did with GameStop and change the rules accordingly and see them off. I don't know if this is going to happen, but the other side of it is actually they will increase the initial margin.
I was gonna say that, and we've seen that in the past whenever we've seen kind of excess volatility or increased volatility rather in the precious metals market, and particularly in silver, is they increase the margin. So what that means is people who are trading on the margin, you have to have funds on your account to effectively, it's a margin account. So if the trade goes against you, the brokerage company wants you to have money in your account so that you can pay for your losses. But as the margin increases, what they'll say is, right, well, now if you're trading 5,000 euros worth of silver, we want you to have 20% of that to cover any fluctuation in the price and the P&L. So you'll have to have 1,000. So instantly they can go, well, actually, we don't want 20%, we want 40%.
Yeah, and the previous form in this, whenever they suspect a volatile marketplace, they're going to increase those margins, not only the maintenance margin, but the initial margin, which is the margin you need to actually to open up a contract. Maintenance margin is what you need to have it overnight or extended period. And they can tinker with that. I mean, they're very, very, if they do and they raise those, that'll take the steam out of the market a little bit as well. I'm just interested to know what's going to happen when the ETFs, the various ETFs that are out there, designed for a normal market, suddenly get inundated. Will these, what happens to those ETFs? Are they able to hypothecate those underlying physical bars? The cost and the premium those bars are sold at suddenly blows out. Will they be sitting on losses? How do they pass that on to the ETF holders? Ultimately, behind a lot of these ETFs is some sort of trust structure, and that trust structure will absorb those losses. So the net asset value of these shares is going to probably, I would think, detract or fall away from the actual underlying spot market price. So you might find these silver ETFs trading at a discount to the actual silver market price, and that is even when they do trade. So I think that's going to be a really interesting one to happen or to see.
Yeah, really good points. Just on that, I think what you're alluding to, I suppose both of you in different ways, is the potential. It's about price discovery, and whether the futures market has been the tail that wags the dog of the physical market, and that's been the gripe that many investors have had for many years. And there's been class action suits and all the rest of it, rightly saying that the futures market can be used to manipulate the prices, and therefore no matter how many, I think this is the point you're making, Dave, no matter how much physical demand there is by retail investors for coins and bars, ultimately, the hedge funds or banks, whoever it is, can use the futures market to cap the price and manipulate the price lower. And also the point you made about increasing the margins on the future side, it's not just volatility that you've seen them increase margins, it's when the price has gone up very significantly that they have increased the margins, So that can happen, and I think it probably will happen again, and I think we're going to see massive volatility, and therefore it speaks to not trying to trade these markets, particularly not futures or CFDs or anything like that, and arguably even SLV. You need to own the underlying physical asset, because ultimately that will command the premium over time, and we saw that obviously at the start of this so-called pandemic, or the COVID crisis, that when there was shortages of even the very large institutional bars, the 1,000 ounce silver bars, the premiums went very, very high indeed, and people were paying 5-6% premium for a 1,000 ounce silver bar, a large institutional grade silver bar. And I think that's what will potentially happen. We've long talked about the potentiality of this COMEX default, and I think that becomes more possible in this scenario, because it's not just millennials, angry millennials, these Robin Hood type speculators. There's some quite wealthy people, and billionaires, and very intelligent people who realize that silver is undervalued. And if some of that money starts going into physical silver, not obviously into the futures market, not into the SLV exchange traded fund, which is basically a share that tracks the gold price in effect. But if they start buying physical 1,000 ounce silver bars in vaults with GoldCore or other established providers who provide silver in a very safe way in Zurich, in Singapore, in London, and in very safe vaults around the world, then the futures price, I think, will potentially become less relevant, and it may in time become irrelevant. If there's no silver in the COMEX vaults, then why would a large silver producer, a massive silver mine that's producing millions of ounces of silver, why would they hedge that production with something whereby they're not actually hedging, they're just buying electronic contract? And also there's some producers and both mints and refineries that we buy from who would take delivery of some of the silver, and they would use futures contracts to take delivery. But if you don't have the ability to take delivery ever, then a lot of these people are going to go to actually not using the COMEX to hedge, or to even take delivery of the asset, So I think there's potentially a real issue for the COMEX, and that is the key here. If these guys just buy, because they're also talking about buying mining shares, silver mining shares, and AG is one of the most favored shares, and it's absolutely surged. I think it went up 20-25% on one of the days last week. I haven't looked at it today. It's Keith Neumeyer, who's a very respected entrepreneur and operator in the silver mining space, and he's a huge proponent of silver and of buying silver in order to protect wealth against the coming economic, financial, and indeed monetary collapse that I think we're on the verge of. But if they focus on the silver mining shares, the silver ETF, and the SLV, that silver ETF, then they won't see what they want to see. But if they buy the underlying physical coins and bars, then potentially they will see what they want to see, and potentially silver could go as high as, I'm not sure about $1,000 per ounce. That's fairly punchy, but it could easily go to $150, $200 per ounce very easily.
If I come in there, Mark, the motivation of someone like, this is kind of like an uprising kind of insurrection against the system. And I think there's a number of ingredients that are feeding it. One is there's quite a lot of liquidity in the market. People have a lot of time. They're empowered through technology where they wouldn't have before. They can aggregate on boards like Reddit and coordinate targeted efforts and see a result and see an impact where they wouldn't have been impactful before on an individual basis. This is quite new, and we're as new in this context, but not new in history. We've seen these type of things in history before, and where people are disenfranchised, they seek to tear the system down, and they take pride in that. I'm not sure this story is really
make the system better.
Make the system better. Well, and sometimes a better system comes out of it, in times. But I'm not sure the motivation of a lot of these people buying silver is for silver's sake, like it's a monetary play or it's a long-term hedge. It may be more speculative in nature, and I would worry very much that the price of silver could go, I'm not saying to 1,000, it could go anywhere, I don't know. Ultimately, you can't rule it out. But a lot of people get caught up in the fuel of those flames, get buy in at a much higher price. It's not fundamentally well supported, and then lose it, and then lose an awful lot of money as that event changes how they look at value, how they look at investing. They say, nothing forces you to lose your mind than the sight of your neighbor growing rich. And that is, I think, very much happening here. People are talking 1,700% returns on GameStop. Maybe GameStop is not as a company is not valid anymore, given online game proliferation, and maybe short sellers aren't evil. Maybe they just see a fundamental misvaluation and they're getting in there. I'm not saying that is the case. I'm just saying that it could be possibly what's behind this. And the manipulation story behind silver might be somewhat different. There might be a bit of ongoing repression, as you say yourself at the beginning, when look at the price performance of silver from 40 years ago, it should be an awful lot higher. So I think there's a number of factors here going on.
So what we're talking about as well now is that what's going on with WallStreetBets and this short silver squeeze is it may actually just be a catalyst. It's really shining a light on the silver market now, and there are people now becoming aware of the silver market and the potential of the silver market that may never have even considered it before. And that what this is doing is it's shining a light on, and it's bringing more people into this market and actually drawing attention to physical silver and the benefit of physical silver over paper silver. Would you agree with that, Mark?
I would, yeah, absolutely. And I think it's also attracting a lot of capital in from the money that's gone into Bitcoin and crypto assets, and that's been absolutely a huge amount of money has gone into that space in the last few years. And those people there's a combination of people who are all about the speculation, as Stephen was alluding to. They're about getting that 10x, 100x, and they're trying to get rich, basically, and it's a form of a get rich quick scheme for them. But then there are also people who genuinely see the value of Bitcoin as, I suppose, a form of gold, as an inflation hedge, as a form of insurance against the system, and as a better form of money ultimately. So I think what's happening is, and it's very interesting, and I think this bodes very well for silver in the medium and long term, both silver and gold. I think the millennials and that younger generation are now beginning to, I suppose, educate themselves about money and the true nature of money and what money is. And that's been lost in our society for years, and I think the Bitcoin movement has done a lot in that regard. But gold and silver was frowned upon and attacked by some of these people. Some of the leading proponents in the Bitcoin movement attacked gold and said it was archaic and barbaric relic from the past and all the rest of it, and they said that was going to go to zero because you could mine gold on asteroids and silver on asteroids and on the moon and all sorts of crazy stuff, but I think so there's a lot of negative sentiments towards gold and silver, and then the media obviously hasn't been covering gold or silver at all, really, neither positively or negatively. The mainstream media has tended to ignore it. Financial Times and Bloomberg would cover it occasionally, type of thing, but your mainstream BBC, CNN, they don't cover it, and when they do, it tends to be very negative indeed. So I think that's going to have to change, actually, and I think this what's happening now is bodes very well. But Stephen's right, it's going to be hugely volatile, and people need to be careful. They shouldn't be speculating. They should be taking at least a medium term view. I think a year, 2 years, 3 years at the very least, and also dollar cost average into physical positions, and then dollar cost or euro pound cost average out of positions. Don't try. A lot of people, particularly that younger generation, but even some of the seasoned investors, they sometimes have their price target of $150 silver, and I'll sell when it gets that price. And with the risk of manipulation, it's still there, as we know. It might never get that price. So why not, when it gets to $50, sell a small amount of silver, or $45. When it gets to $90, $95, sell a small amount of your silver allocation and rebalance into gold if gold's more valuable, or rebalance into other assets that are more valuable. And then when it gets to 140, maybe sell a little, but always have that core physical holding, that 5-10% of your portfolio. I think you should always have that genuinely, because there's always going to be risk in the world, particularly in the coming years. So, but you do have to have your eyes in the exit as well, and not be having that get rich mentality, because it's very, very risky for people.
One thing I want to touch on for a minute, gents, the other side of this trade primarily is some very big money. It's what they call, very big smart money. Whether you think it's smart or not is besides the point. But we've got some big names in there, the bullion banks. Now, historically, JP Morgan would be the biggest player in this, and historically, it was always assumed that JP Morgan had a massive short position in the futures market. There are rumors that their short position has either reduced or been squared up over the last while. But there is still going to be a potential for a massive reaction, whether it happens this afternoon or happens over the next couple of days in the silver market. And I could see this going either one of two ways. Either they give this short squeeze a lot of credibility and they start to actually square up their short positions, which is going to put a very big bid into the market, and we're going to see a massive jump higher in prices. Or alternately, what they have done a lot in the price, or in the past rather, is give the futures market a good kicking. And that's where they start, and they just sell. And they put in some massive sell trades, and it can be done at very illiquid times of the day. So you might see that happening. In the past, it's happened at 2 o'clock in the morning, massive trades going through in illiquid markets in an attempt to drive the price lower quickly and drive through all of those stops. And there will be a lot of stops, because if there are people that are using their brokerage accounts, margin accounts to go long these silver, they don't have deep pockets. And these large bullion banks have deep pockets. So they can drive this price lower during illiquid markets and force everybody who is using that method of getting into the market, they can force them out of the market. So which way, Steve, do you think that, I know it can go either way, but do you fundamentally think that the bullion banks are going to do what they've always done, or is this a change?
I totally agree with what you're saying. I think the people who saw some success with GameStop and similar names are making very tentative connections with that and the silver market, which is a different beast altogether with different players, as you've alluded to. But I also think officialdom doesn't like this. The White House doesn't like this. The SEC don't like this. They don't like the system being challenged, because this system gives them power, and so they will be quite happy to endorse any kind of slam down of the market. Force those force those longs out of the market very quickly. And yeah, absolutely. I mean, we see it in gold quite regularly. There was a massive trade in gold there a few weeks ago. It was done exactly at the wrong time for the market, and it was like 1.4 tons or something were sold in a matter of seconds, multiple times what the value of the market would normally be. And so, there's an awful lot of people who, hidden hands, whatever you want to call them, that get involved. I think, they're probably looking forward to teaching this group of people a lesson. And maybe they'll do it with silver. Maybe they'll let it go for a while, let it build up a position, and give them some, wins, and then suddenly it'll just come in, a massive sell-off.
Mark, your thoughts?
No, I agree. We've seen it. Dozens and dozens of times over the years. We covered it in our market update and spoke about it on mainstream media. And it's there. The Justice Department have prosecuted these people. The CFTC have found them guilty of doing it, and that includes J.P. Morgan, Bank of America, Merrill Lynch, Deutsche Bank, and Scotiabank. So and that volatility will put people off. So you have to prepare for that volatility and realize it will happen. And who knows, they may maintain control ultimately, these markets, because I think they do get a free pass from officialdom, as we're suggesting there. So we may see a form of managed retreat, because I remember when we were talking about silver back in 2003, and we were telling people silver is great value at $5, $6, $7 per ounce, and people were scoffing at us and saying silver is a barbaric relic from the past, and silver's manipulated and don't buy it, blah blah blah. And it went up 10, 12 times, obviously, between the early 2000s and 2011. I think we're going to see the same thing again, but there'll be massive manipulation along the way. From $5 to $50, there was massive manipulation, massive drops, including a drop from $20 to $10 at the outset of the great financial crisis in 2008. So silver fell 50%. So we are going to see that scale of volatility, and that speaks again to staying the hell away from electronic silver and leverage silver, and buying the underlying physical assets. I think they'll have to engage in, at the very least, engage in a form of a managed strategic retreat. It's like they're not going to win this battle right now, so they're going to pull back, and they might let it go much higher and then manipulate it. But who knows? As you said, Dave, are suggesting overnight in Asia, we could see quite a big smackdown. And it tends to happen when silver is in the headlines as well. When silver gets into the front pages of Financial Times and gold, that tends to be a good time to take profits. Because the retail guy tends to be in over his head. So it could be at $30, which we just hit. It could be at big round numbers, $30, $40, $50. We will see a very serious smackdown, But people should use that to be buying physical on the dips, obviously.
And just a couple of observations there, just to sum up. One of these things is we probably, and you both would probably agree with this, is caution people about over leveraging themselves when they're getting involved in the silver market. We've always talked about the benefits of physical silver. So it's a case of buying physical silver with cash that you have. This is not about getting leveraged, seeking those returns, because that way disaster potentially lies and you can actually wipe yourself out. But the benefit of taking physical silver into your possession or having it stored can't be underrated at this moment in time. And particularly if you are of the opinion that silver goes significantly higher, that's the route to go down. Would you agree with that, Steve?
Absolutely. I mean, like, we think silver serves the customer best when it's part of a diversified portfolio. It sits alongside gold. Yes, it's a bit more volatile, but ultimately, in a world where money is being printed to beat the band, we're changing the very nature of our capitalist economies, and there's an awful lot of, I think, trouble ahead as a result of the liberal quantitative easing and money printing activities of our banks and governments everywhere. I mean, there's a wall of money coming at us. If you can park some of your cash in your portfolio into something like gold and silver and have it physically stored in a secure vault in a safe location with a serial bar number on it, segregated from everybody else's and available for sale or transfer or transport, whatever you want, that is going to really serve you well as part of a diversified portfolio. So that is what we specialize in. We have significant stocks of physical silver in Zurich today. We have 100 ounce bars, 1,000 ounce bars, and coins. They're a little bit tight right now, but they're going to come back on stream in the next few days, hopefully, and we will make a market in those as well. So definitely the physical silver. It's not about leverage. Don't try and be a speculator or play a game that you haven't trained for. You're not paying attention to the markets as you need to if you were a speculator. As an investor, long term, look at the 3, 5, 10 year horizon, and always have that physical precious metal allocation in your portfolio. I think it'll do very well.
What I'll do is I'll put in the show notes, I'll put the links, but for our Irish audience, it's goldcore.ie. From the UK, it's goldcore.co.uk, and for everywhere else, it's goldcore.com. And what I want to do is actually just leave you with a thought. We had Christopher Mullen of the Technical Traders on as a guest on GoldCore TV a couple of weeks ago, and one of the things that Chris had talked about and said, one of his rules or his observation, particularly when it comes to the charts, is that gaps nearly always get filled. Now, what we've seen is we saw the market gap up on the open after the weekend, and it gapped up significantly. There is a good chance that that gap gets filled. What that means is there's a good chance we see a pullback that fills that gap. Maybe not today, maybe not tomorrow, maybe it's in a week's time or whatever it is, before it goes higher once again. So to everybody that's out there, you want to have the stomach to weather these. If you don't, then you probably shouldn't be involved in the instrument that you're involved in. Only play with what it is that you can lose. Go down the physical route with coins or bars in the safe way with money that you can afford to lose. Don't get over leveraged and avoid the paper market.
Yeah, and long term. Very
long term, yeah, on the physical. And I don't know if you can see that.
Excellent. All right, listen, Marco Byrne.
That's silver. You see it? Liberty. And that's what silver confers. It's liberty, and it makes you sovereign. It makes you independent of the system ultimately, So, and that's ultimately what's about in the uncertain world of today.
Excellent. Marco Byrne, thank you very much. Stephen Flood, thank you very much. For anybody else, anybody watching here, what I'd like you to do is to like and subscribe, share this video with anybody that you think needs to see it. And it is important that it gets shared far and wide, because it's important that people understand the fundamentals of this market, how it works, what they're up against, and what the game is that's being played. It's fundamentally different to the GameStop market and the equity markets. So people got to make sure that they don't get burned, and that they're careful, and that they're making intelligent investment decisions. Like and subscribe, as I say. Hit the notification bell, because then you'll get notified next time that we go live. You can find out more on goldcore.com. Thank you very much.
Thanks, Dave. Thanks, everybody.
Bye, everybody.